Welcome back, investors. Jake here. In this video, we're going to talk about the small cap index fund and potentially why it's been underperforming the broader market. My personal 401k is with the government TSP since I'm a government employee, and basically in my 401k, I only have 5 options. And 2 of them are the C fund, which stands for Common Stock Index Fund. This is the S&P 500 Index Fund. The other one is the S Fund, which stands for Small Cap Stock Index. And that's basically every other stock on the New York Stock Exchange and the NASDAQ that's not in the S&P 500. And on my channel, when people ask me what should I do in my 401k or my retirement account, I just tell them go 100% S&P 500 Index Fund. The long-term average with dividends reinvested over a 20-30-year time period is greater than 10%. That's a fantastic return in a retirement account. So for the last 2 years, I've just been in the S&P 500 index, and my performance over the last 12 months in my retirement account is 27.5%. I really can't complain about that kind of return. So in this video, let's compare the S&P 500 Index Fund versus the Small Cap Index Fund. And we're going to use Vanguard's equivalent funds to basically talk about these. These are the ones that anyone can buy with any brokerage accounts. For example, Vanguard's S&P 500 Index Fund ETF is VOO. Vivifax is their mutual fund equivalent. But maybe you're in State Street's SPY or BlackRock's IVV. I'm sure Schwab also has one. So there are lots of equivalent index funds that you can buy from the different brokerage firms, but they all perform the same because they're all tracking the same index. And one of the most popular ones is the S&P 500. So when we look at the 10 largest holdings in this index fund, we have number 1 being Microsoft, 2 being Apple, 3 being Alphabet or Google, 4 is Amazon, 5 is Tesla, 6 is now Meta, but it's Facebook, 7 is Nvidia, 8 is Berkshire Hathaway, 9 is JP Morgan Chase, and 10 is United Health Group. And these 10 companies, they're so large, this is a market cap weighted index fund, they're so large that they make up 30% of the entire fund. So 30%, if you buy this index fund, 30% is just in these 10 companies. The other 70% is the other 490 companies in the S&P 500. Now the S fund equivalent is Vanguard's Extended Market ETF, ticker symbol VXF. And this is once again everything not in the S&P 500. Number of stocks, guys. 3,646. That's a lot of companies. And you can look at the 10 largest holdings in this fund: Square, Blackstone, Snowflake, Uber, Zoom, Airbnb, Marvell, CrowdStrike, Lululemon, and Snap. All of these companies ideally want to get into the S&P 500. They're very large companies, but there are certain standards that they have to meet in order to be eligible to get into the club, and then basically somebody in the S&P 500 is going to get kicked out. So of these 10 companies, they make up 8% of the total fund weighted by their market cap. So the other 92% of this fund is the other 3,636 companies. So there's a lot going on with this fund. Now maybe you've heard of a total stock market index fund, and that would be Vanguard's VTI. Mutual fund equivalent is VT-SAX, and this has literally everything on the New York Stock Exchange and the NASDAQ combined. Number of stocks, 4,124. So what VT-SAX does is it gives you VOO and VXF by market cap. And it's probably, it's still pretty large. So the 10 largest companies in VOO are still the 10 largest positions in VTI, except instead of making up 30% of the funds, they make up 24% because you got to factor in all the small caps. And historically, the S&P 500 Index Fund and the Small Cap Index Fund have performed about the same, with the small cap having more volatility. So I can show you this on the government TSP website. Once again, C fund is S&P 500, S fund stands for small cap. And when we look at their performance going back to 2002, they almost mirror each other. Basically, small caps are competing with the large caps for profitability, growth, investments. So when the whole market goes up or down, they basically perform the same. However, where this has diverged is in the last 2 years. So in 2020, the small caps over a 1-year period performed up 31.85%, and the S&P was only up 18%. Still a good year for the S&P, but the small caps almost doubled the return. And now this year, it has flipped, with the small caps year to date only being up 11%, and the S&P, meanwhile, is up to over 23%. So what can explain this? The small caps had a fantastic run in 2020, and when we look at VXF, we can see this, that the fund basically peaked back in February, and for the entire year, it's been flat. Since February, VXF, for the small cap index, is down 3%. It hasn't gone up at all, while the S&P 500 has continued to grow. And in this video, I want to argue for you that the reason why the small cap index has been underperforming is twofold. One is massive share owner dilution through issuing new stocks. Lots of these smaller companies need to raise equity in order to grow, and they can either do that by taking on debt, which they do, or they can issue new stock. And when they issue new stock, they're basically diluting you as the current shareholder. That's the first cause. The second one is just the sheer volume of new companies going public, either through direct listings, SPACs, or IPOs. Here's an article from CNBC, Jim Cramer saying, "Why too many IPOs are bad sign for the market." And this was published back in August, and he argues that when you see a lot of companies coming public, especially a lot of low-quality companies, then this is a very bad sign for the averages, the index fund holders, because it means the stock market is getting flooded with new supply. Just like printing more money causes inflation, which is bad for the value of the dollar, when you basically print more stocks or you have new companies go public that flood the market with stocks, this is bad for the index fund holder. Here's an article from The Street titled "Top IPOs of 2021 So Far." There have been 953 IPOs on the U.S. stock market in 2021 so far, which is an all-time record. And the small cap index fund can't differentiate which are the good ones and which are the bad ones. It just adds them all. So this number of stocks in the index of 3,643, that includes these 953 added this year, diluting you potentially if you're a small cap index fund holder. So let's read this article a little bit. There have already been more IPOs through the first 3 quarters of 2021 than there were in all of 1996 during the dot-com boom, which led to the dot-com bubble, which led to the dot-com crash. The previous best year ever for IPOs. In the first 9 months of this year, 953 companies have gone public, compared to 664 for all of 1996, and 555 last year. So as of November, this is 141% more than the same time this time last year. We've got names you've heard of: Bumble, the dating app; Oatly, Robinhood, the brokerage platform. Startups are taking advantage of low interest rates and stimulus from the Federal Reserve, and investors are heavily craving rapidly growing startups amid the boom for SPACs, which has become a popular way for companies that are looking to go public with less regulatory scrutiny. So IPOs at least are being vetted, and their books are scrutinized by the syndicates very heavily. Whereas with SPACs, I mean, it's basically a way around the IPO process. Now, there still are plenty of decent SPACs. This article mentions Virgin Galactic, DraftKings, WeWork, but I mean, some of these SPACs aren't gonna survive, guys. They're not gonna be around, maybe even a year from now. It also mentions Lucid and SoFi. There's also direct listings that have been occurring this year with Roblox, Coinbase, and Rivian Automotive. So all of these companies are just trying to get on the market, get on the New York Stock Exchange and get bought up. They're issuing shares, they're diluting their shareholders, and the index funds have to add them. So with all these IPOs, SPACs, and direct listings, there is a lot of buzz when they initially go public. For the first couple weeks or couple months, there's a lot of goodwill towards these companies. We don't really know what their future potential is based on their revenue growth. Most of these companies actually don't produce earnings. They can't make a profit yet. But we've just kind of accepted that this is normal operations for companies that recently go public. So let's go back to the 10 biggest IPOs of 2020. It's really too soon to see what the performance is like of the companies that have gone public this year. But if they went IPO in 2020, we now have almost a year or more worth of information. So how can we evaluate some of these companies? And this article mentions Warner Music Group, Li Auto, Rocket Mortgage, Xpeng, Snowflake, Unity Software, Palantir, GoodRx, DoorDash, and Airbnb. And we can just go through some of these, and I'll just tell you guys what I think is happening here. So here's Rocket Companies. They IPO'd August 7th of last year, and initially there was a lot of buzz, and it shot up, but from its high, it is now down 42%. So you have to ask yourself, if you're a small cap index fund holder, when did your index fund buy this company? It probably bought it in the first month or couple weeks, somewhere around here, and you're now down. I understand that with IPOs, they can get an IPO price that's pretty decent, and then on the first day on the market, the share price shoots up and they can just sell for a profit. But for index fund holders, it takes a couple weeks or maybe a month for it to be added to your index, and it just drops. It just drops every time. So here's Palantir. Once again, lots of tremendous buzz the first couple weeks or months, and then from its high, it's down 46%. So if your index fund added you around here, then the people who bought it on day one or day two, they just wait for the index funds to add it, and then they cash out. Like, I seriously think that's the most obvious play that these people are making right now. Here's DoorDash, IPO December 11th, shot up initially 17%. Maybe this is where the index funds all added it, and since that point, it's down 20%. Same thing with Airbnb, lots of buzz, shoots up 52%. The index funds are going to add it somewhere around here. They're then the bag holders, as you know, from its high, it's down 16%. To illustrate the absurdity of what's going on now with small cap index funds adding literally everything, we can just look at the most recent IPO to get a lot of buzz, and this is Rivian Automotive. It's an electric vehicle car maker. But Rivian is now the biggest US company by market cap value to have no revenue, no sales, nothing at all. This company went public before it sold anything. And when you look at Rivian's market cap value, it's $104 billion, which is just objectively absurd for a company that's never sold anything. It doesn't have any revenue yet. When you look at General Motors, for example, market cap is only $88 billion. How much in revenue did General Motors do? And they did, in last year, $130 billion. So Rivian, which hasn't sold a car yet, has a higher valuation than General Motors. The same thing is true for Ford. Ford's market cap is $79 billion, and they did $134 billion worth of revenue. It's just absurd, guys, the valuations that these IPOs and SPACs are getting, and the small cap index funds have to buy them. They have to buy them at their weighted size. So there might be really good companies in the small cap index fund whose market cap is only $1 billion. They're the ones growing. They're the ones that are performing well. But a company like Rivian, the small cap index has to buy 100 times more shares in order to get it proportional. And what do you think is going to happen with this company, guys? This is going to crash hard. I can see this easily dropping to like 20 or 30 bucks a year from now. And that's just what's been happening. There's so much froth in the small caps that it's underperforming in the index funds and it's dragging people down. And just think about this, guys. Think about how many companies there are right now. 3,646, and 1,500 of them almost were created in the last 2 years. Do you really think all these companies are going to survive? And if they do go bankrupt, if they do go out of business, if shareholder equity is wiped out, it's the small cap index fund holders who are going to be hurt the most, basically. For those reasons, I just like my chances better holding the concentrated S&P 500 index fund because there are standards and regulations to be admitted to this exclusive club. I'm less concerned about shareholder dilution and devaluation and potentially companies going bankrupt. You know, companies like Microsoft, Apple, Google, Amazon, these are real companies with real growth and real profitability doing stock buybacks. I would rather concentrate my retirement funds here than in the wild, wild west, basically, of the small cap funds. Okay, guys, that's all I got for this video. If you enjoyed this content, give me a thumbs up so the algorithm knows it's good. If you guys know something I don't or I missed something, let me know in a comment down below. I love hearing from you guys. Till the next video, take care.